Today, we're going to break down the most shared Instagram tax posts. And I want to get your take on, can I write off a 4,000 pair of Michael Jordan shoes? Welcome to Office Hours, a tax podcast by Fujikawa Associates. And we're your hosts. I'm Josh Baldovino, one of Derek's clients. And Derek Fujikawa is the managing partner of Fujikawa Associates. Derek, how are you doing today?
Thanks. How are you doing?
I'm good. So I feel like every single CPA has varying opinions. Why do CPAs vary on their advice to their clients?
Yeah, so it depends on the CPA himself or him or herself. The tax code defines everything, and you use that as a guideline. There are a lot of gray areas. You may be able to interpret something a little bit more aggressively, or some may interpret it a little more conservatively. And so it could range from different CPAs. Some may be more on the conservative side, don't want to deal with the IRS and say, hey, just follow the law. Or you could be more aggressive and say, hey, there's a gray area here. We can interpret it this way. And I don't have any problems doing that with my clients, but I always let my clients know that, that, hey, we're taking an aggressive position. You need to make sure that you have all your backup so that if this is ever a question in the future, you're ready to go and can show that you have all the documentation to support your position. They may or may not accept it, depending on how they interpret it. As long as you have your backup documentation, you've done what you can.
Well, with that being said, then let's just dive right into it.
Sure.
Let me pull up the first clip, and I will refresh the screen too. So we'll do STR tax loophole first.
And I got into real estate investing because I heard you can pay less taxes. But I just filed my return and I couldn't use any of it to offset my W-2 income.
That's because you're not a real estate professional.
But I don't want to quit my job. I make too much money here.
Have you considered renting out some of your properties on Airbnb as short-term rentals?
How will that make a difference?
When you rent out a property as a short-term rental, you can potentially write off all of your losses against the high W-2 income from your job, even if you're not a real estate professional.
But I didn't get into real estate to lose money. What are you talking about?
All right, by loss, I don't mean losing money on your investment. I mean strategically creating tax losses like paying your kids to help out in your real estate, deducting your trips to visit the properties, car expenses, and depreciation.
That sounds amazing, and I don't need to quit my job to do this?
That's right. No need to quit your job. You can keep real estate as your side hustle and still get this tax benefit.
So what do I need to do to qualify?
You need to meet material participation hours. One example is putting in at least 500 hours a year into the Airbnb business, but that wouldn't be too hard.
I'll look into it. How do I learn more?
Follow Amanda and Sean for more real estate tips.
That is clip number one. True or false?
Yes, that's a great way to save on taxes. Anytime someone has a W-2 job and is looking for ways to reduce their income, that is one of the first things that we'll talk about. Now, it's not easy. You're going to have to buy a short-term rental property, manage it, put in 500 hours a year. But if you're willing to put in that work, it's a great way to offset a big portion of your W-2 income. You could do a cost segregation analysis, use bonus depreciations. In the past, it's been 100% for any items that were 20 years or less of useful life. You can now take 80% in 2023. If you're looking to do something like this, you can't purchase a short-term rental. You need to rent it out. The average is 7 days or less, and then get those material participation hours, a huge write-off against your W-2 income.
That's pretty much the only way that you can do it, right? In terms of if you had W-2 and wanted to real estate, because otherwise a long-term rental wouldn't qualify, right?
Correct. Yeah. So even if you have material participation, it's still a passive activity. So if your income is over $150,000, then you can only deduct your expenses down to your total income from the property and basically create a net break even. Okay.
That's what I'm excited about. I want your hot take. How can I get custom Jordans for $4,000 and write it off, Derek? Tell me.
Let's take a look at this.
Here's how I'm able to write off luxury shoes. You see, these Air 1 Jordan Dunks are one of one, and they're made out of lamb skin and crocodile skin. And one of the things that I had them do is I even had them put snake skin, aka anaconda skin, on top of these shoes. But the reason why I'm able to write these off is because I do a lot of speaking events, and these shoes are a part of my brand. I even had them insert my logo on top of the shoes, so I'm able to wear these shoes at any of my upcoming Tax Alchemy events. These shoes are typically only worn when I'm doing speaking events or I'm doing photo shoots, and they cost me about $4,500. And I'm able to write these off on my tax returns because these are business equipment that I'm using for my speaking event. Comment below if you've ever wondered how you can write off clothing inside of your taxes.
So this goes back to the initial talk about how aggressive you want to be. This is being pretty aggressive. If you have a brand, and you can use that as those types of purchases, but they also will kind of look at things and see if they're excessive. If you can prove that your brand does require that, then you could show that it's an ordinary necessary business expense. I'm not going to say it's totally out of the question, but it's very aggressive, and you would need to show that it's ordinary and necessary.
He did do a full YouTube video on this. I watched his entire video on this. In his bylaws for his corporation, he also put that he is only serving luxury clients, and so he needs the top of the line everything. Does that help?
That's part of that backup. Maybe justify that it's ordinary and necessary. Now, that doesn't say that the IRS is going to let it fly, especially if you're buying growing a lot over the course of the year.
So it is potentially possible, but it's also more likely that you would at least raise some eyeballs at you. Next video, we have, how can I use my Roth IRA to buy a property?
Let's see.
So what's so amazing was that this particular client had close to $100,000 in his Roth IRA, which he used to buy a piece of land. This piece of land was purchased close to an area where he knew a hospital was going to be built in just a couple years. So now fast forward a couple years later, that $100,000 property is now worth close to $800,000. So he never has to pay taxes on any of that appreciation simply because it was purchased in his Roth IRA. That's the power of using retirement money for your real estate deals.
Yeah, this one definitely works. Within your retirement account, you can buy pretty much any type of assets. There are a few that are not allowed, but real estate is allowed within your retirement accounts. A Roth IRA, which she mentioned, is great because any growth in a Roth IRA is tax-free. So once you reach retirement age, you can pull all this money out tax-free or pass it on to your heirs tax-free. The only caution is you have to be careful if you need to take a loan out on any property that you're buying. So there are some issues with loans because you need to be able to make sure that the retirement plan can service that loan.
So what I'm hearing is that logistically, if I had $100,000 in my Roth, just buy $100,000 piece of land, no mortgage on it, and it grows, appreciates, and I sell it. As long as it lives inside there, we're good?
Yes, as long as you can maintain it within the IRA, right? Like,
so if I were to buy a property and make that a rental property, I would just have all that rental income. With a rental income, then go deposit into the Roth? Or like,
yeah, so everything should stay self-contained in the Roth. So all that rental income won't be taxable, and it'll just go back into the Roth, and then you can build up your cash reserves and maybe eventually buy another property with the money that it's making. Or
so don't withdraw from your Roth, just buy it in your Roth.
Yeah, as long as you have enough in there, right? Yeah.
All right, next one. How should you pay yourself is the next clip.
Okay.
How much salary should you pay yourself out of your S corporation, assuming you work in the S corporation? First, it needs to be reasonable. In other words, what would you pay somebody else to do the work you're doing? Number two, if you do 50% of the money you take out as salary, the IRS is probably going to be okay with that. There's no hard and fast rule, but 50% should work. The third thing to remember is the amount of salary affects the amount of qualified business income deduction. So don't forget that part as well.
So yeah, I agree with everything you said there. So you do have to take a reasonable salary. That's actually written into the IRS code. So anytime I get a new client that is an S corporation, I get that line for officer compensation, make sure that they're paying themselves a salary. And if not, I tell them you got to start doing that right away, because the IRS will come back and say you should have been paying yourself a salary, assess your payroll taxes, all that stuff. So 50% rule, that's something that I use if it's a relatively small S corporation. You know, it's not necessarily for everybody, but if you're paying yourself 50%, you're probably okay. If you're making 3 or 4 million, you may not want to pay yourself a $2 million salary. It just has to be reasonable for the work that you're doing.
When they say salary, is that like a bi-monthly, a monthly, quarterly? Like how often should you be paying yourself?
It should be paid regularly. You could just bonus yourself at the end of the year. If you receive a W-2, the IRS assumes that it's paid ratably throughout the year, regardless of when it was paid. It should be paid evenly throughout the year, either monthly or quarterly or bi-weekly, however you want to do it.
Okay. Next one is kids in your business.
Who here has kids? You can pay your kids in your business up to $12,950 per year, and it's completely tax-free to them. So your business gets a $12,950 deduction. Your kids get $12,950 tax-free. Next year it's going up to almost $14,000. Who wants your kids to be millionaires? You pay your kid $12,950 this year. It goes into a bank account with their name on it. Take $6,000 of that, put it into a Roth IRA for them, because they're going to have a W-2 now, so they can contribute to a Roth. If you did that for 5 years, $6,000 for 5 years, 30 grand, at retirement age, they would have $2.3 million from you putting in 30,000 bucks.
Yes, another strategy that I definitely recommend is paying your kids. So they actually have to work and you have to pay them a wage. They're old enough to do some filing, shred documents, do things like that. You can add up the time, and here in California, minimum wage is pretty high. So this is a great way. You can pay them up to the standard deduction. None of their income would be taxable. I mean, you can pay them more, but anything over that standard deduction would then be taxable, but at a low rate. So you just want to do that whole free amount, then just go up to that standard deduction. You get a deduction in your business. They don't have to pay taxes on that money. And then, yes, you contribute to a Roth IRA with those earnings, and they're not getting any deduction for that Roth contribution, but they don't pay any taxes, so it doesn't matter. So they put that money into a Roth that grows tax-free. It's a great way to transfer wealth as well as reduce your overall tax situation.
How often are you seeing your clients do this?
It's not real common, but I've seen more and more clients doing it. If you have a business that's profitable, it doesn't make sense if you're losing money already then to try and transfer money. But if you have a profitable business, definitely makes sense.
Okay, next video is an advisor versus a preparer. I think you know where that one's going already.
Yeah.
I owe $187,000 to the IRS. This is one of my newest clients. This is what she came to me saying, David, I owe this much money. And I said, how can that be? And she said, well, I made a lot of money. I said, how do you know you made a lot of money? She goes, that's what my CPA told me. And I said, oh, okay, well, let's look over your tax returns. And when I came to look at those returns, I realized there was one change, one little tweak that we could make on that return that was gonna save her $68,000. And that was just in meeting me for the first 10 minutes. So as soon as I said that, she said, how come my CPA didn't share this with me? And I said, the difference between a CPA and me is I'm an advisor and they're a preparer. I proactively look for ways to save taxes and they have a strategy to file a return. We have different skill sets, but which one matters right now? And she says, the strategist, the guy that does the advising. That's you, right? I said, that's exactly right. And because of that, we worked with her and we not only found her that $60,000 or $68,000, we actually found her $110,000. And now she's not gonna be paying all that money to the IRS. And guess who's their best friend today? I am. And I can help you just the same. And if you want more information on how we actually did it or the strategies that we use, please click the link below to like and follow me because I share these strategies every single day.
So yes, that's definitely the way to go. We do tax returns. I've been doing them for years, but when people bring their tax information to us in February, March, the year's already over. We can't do anything. So all we can do is prepare the return, let them know what they owe. We've been working more on the advising side now and trying to work with clients throughout the year. You can actually do stuff that affects your tax return that's going to be due next April. We can make suggestions on hiring your kids or buying a property or doing something else. Definitely suggest finding someone that can help you, guide you throughout the year versus kind of reacting at the end of the year.
A perfect scenario for your advising clients. How often would you like them to touch base with you?
Usually at least quarterly, just to check in, see how things are going. On top of that, if any major event is occurring, major life events or major financial events as well, it's always good to take a look at your situation, see if there's anything you can do, and then we can make a decision there as to what you could do to make any changes.
Fair enough. We got 3 more, domestic versus international. I'm not entirely sure.
Travel, another favorite deduction for business owners. Here's the rules for domestic versus international. For domestic, so within the US, you just have to have 50% of the days to be business related. Say you're going on a business trip to Disney World because you need content for social media. That's 7 days. You need 4 of the 7 days to be business related. The way there and the way back automatically count as business. So you only need 2 more days in there. So maybe one day you do a photo shoot at Disney World for the gram. And another day you have a business meeting or prospect meeting with someone. There's your 4 days. So that trip to Disney World counts.
Yes, that works. So travel days are considered, if you're traveling for business, your flight and everything, those would be deductible if more than 50% of your time spent was for business. It falls back to that ordinary and necessary. Optics of everything will determine how, say, an auditor would look at it.
Okay, last 2, paper law strategy.
Here's how you can avoid 100% of your income taxes every single year. We call this strategy the paper law strategy. In order to use it every single year, you have to understand the rules. The very first thing that I'm going to need you to understand is you're going to need to buy an investment property. When you buy a rental property, it could be an Airbnb or it can be a long-term rental. But as soon as you purchase the property, I want you to write off everything that's on the inside of the property. This could be appliances, bathrooms, tubs, cabinets. And when you write off everything that's inside of the property, it creates a big expense. We call this the cost segregation study. Once you do the cost segregation study, it creates a big enough loss to offset your W-2, your 1099, your stock, and your crypto income, making you tax-free. Comment below if you'll be investing in real estate to avoid W-2 and 1099 income taxes.
This is a great strategy, but he is making a lot of assumptions that you're going to have enough deductions to offset all of your W-2. If you have a $500,000 W-2 and $200,000 of deductions on this, it's not going to offset all of your W-2 income, but a big portion of it. Yes, you can get a huge tax deduction by taking this cost segregation. One thing he doesn't mention is he does mention long-term rentals, which are passive. Even if you have a lot of paper losses, that depreciation from the cost segregation, you may not be able to take those against your W-2 income, or most likely won't unless you or your spouse qualify as a real estate professional. Not all rental properties would qualify this on face value.
Fair enough. Last one is S Corp versus LLC, which, by the way, we actually already have a full podcast, another video on that. So I'll link that down below in the description. But
Sure.
Just for the quick reaction.
All right.
starting an S Corp. Why is that powerful?
Because now you're taking the LLC, or you're starting an LLC that you never had, and you're taxing it as a separate entity to the IRS, which we can dive into now, or if we want to go.
So when I do an LLC, all I get is a limited liability company. I have some legal protection. If I'm just a sole proprietor or an LLC, I could take a lot of deductions and write-offs. But what's unique about an S Corp that saves me more taxes legally?
When you're self-employed, you pay self-employment tax, which is about 15%. When you're a W-2 employee, you pay 7.5%. Your employer pays 7.5%. If you're self-employed, you're both, so you pay the entire 15%. The S Corp is a great way to lower the amount of the 15% tax that you have to pay.
So if I establish an S Corp, what kind of tax savings could I experience if I was making $50,000 a year as a self-employed YouTube creator?
$50,000 would probably save you easily $3,000, because the example I use most of the time is about $100,000, and will easily save somebody making $100,000 $6,000 to $8,000.
So simply by setting up an S Corp and then running things properly, I could save $3,000 that I would not be paying IRS, that I would legally be just keeping inside of my business or keeping myself personally at the end of the year with less taxes.
Exactly. And I want to make it even easier. It's not even setting it up. It's simply a form that your accountant files telling the IRS, your LLC, I'd like to treat it as an S Corp. Think of an S Corp as this hat I'm wearing. It's just something that your LLC now is treated as. So you already had the LLC. You're just telling the IRS, hey, I want you to treat this LLC as an S Corp.
Is that easy?
Actually, there's a form. You could set up an LLC and elect to be treated as an S corporation, or you would incorporate as just a corporation, and then an S Corp, and then elect S election with the IRS, which then gives you that special tax status. And it does, at the beginning, there was a little bit where they were talking about an S Corp is its own entity and LLC is not. An LLC is actually a separate entity, but if you're a single member LLC, it's considered disregarded for tax purposes. So then it just goes on your individual tax return.
Okay, awesome. Well, that is all the clips, Derek. Out of curiosity, how many of your clients just send you random tax videos just to say, is this true? You ever get that?
Yeah, I get some, but not as much as I thought I would.
You are watching this and you're one of Derek's clients, then send him more tax things.
Yeah.
That way we can also react to it. This is kind of fun.
And I learn a lot from others too. I don't profess to know everything there is. Hearing other people's opinions and strategies are always good to know.
If you are watching this and you liked this style of video, definitely let us know below. Derek, how can people find you if they want to connect with you?
Contact me on Instagram. My handle's there. You can DM me there. Email me or check out my website. We'll have that in the description. Be happy to talk to you, even just answer a few questions.
We'll link all of those. And again, if you can challenge us and find us a really interesting tax video to react to, I think that'd be fun. Well, Derek, thank you so much. And see you on the next one.
Yep. Thank you.